Welcome to our episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Buck Joffrey. He is a surgeon turned serial entrepreneur, real estate investor, and financial educator with over $2 billion in real estate transactions. After completing his surgical training at the University of California, San Francisco, Buck quickly transitioned from medicine to entrepreneurship, building multiple businesses across real estate, internet, and health sectors. Buck, thank you so much for coming on the show today.
Thanks for having me.
So tell us a little bit about yourself. I think you grew up in the real estate business, but let's talk about kind of like what you were doing before you really, bit the bug and got in there and started being a real estate investor and launching your own firm.
Yeah. So, I think my background with real estate is that my dad, first generation, I'm a first generation guy. So my dad's an immigrant, came over, also a, highly educated guy, from India in the late 60s. And he got the bug, like he had a job and really quickly realized there was this other world of real estate. And, he started buying like little single family homes and duplexes and stuff. So, he started doing that even before I was born. So, so my childhood was basically him being a landlord, right? And it was like not a very attractive thing to me, because we were getting calls all day long about, toilets, termites, and the usual. And, I didn't want anything to do with that. So fortunately I grew up in a reasonably, well-off family. So, I went to prep school and, was a good student. I was an A student. So what do? You go down the A student, pathway, right? And you end up going to a nice college and then you major in something. And the next thing you know, you have another decision point. And for me, ultimately, that ended up being medical school. I went to medical school, started out as a neurosurgeon, and ultimately ended up as a cosmetic surgeon, but brains to, something else. But but what happened to me was like when I finished my training, I had the opportunity to accidentally run into a Kiyosaki book when I was coming back from my honeymoon, which was just a week after my training ended, and I had no idea who Robert Kiyosaki was. I had no idea anything, but there was only like 2 books in that Mexican airport. One was like, long hair, a naked guy, like a Yanni type thing or whatever. And one was Robert Kiyosaki's cash flow quadrant. So I'll just pick that out. I don't know who this guy is. I'll read it. I read it. And, it's so funny because these books are so simplistic, but there was a very transformational kind of moment for me, just realizing that there was this whole world of entrepreneurship and, maybe I should be thinking about more than just, being a physician. And it really affected me dramatically. And so that I ended up practicing, sort of based on those principles of entrepreneurship, didn't brand myself very much. I branded businesses and things. I started a few different health related businesses and I was making money and then fell back into my roots of my dad buying real estate instead of investing in the stock market. Because we never did. I shouldn't say we never did that. He did that in the 90s and got destroyed. That was my only experience with the stock market. He was in the .com bubble. He got greedy and he got destroyed and that was it. So I started buying some real estate, wanted to learn how to do more, started listening to podcasts, realized a lot of the podcasts weren't talking to me because I was not trying to get out of a cubicle. I was already making good money, wanting to understand how to scale. And so ultimately realized there wasn't really a podcast for people like me. And so I started one and it focused on, personal finance for high paid professionals.
I think one thing that's very transformational in that Rich Dad Poor Dad book is, yes, you're the employee going over to the other side, but I think it's really is that the self-employed, which I was always self-employed, and the business owner. And I don't think people break that apart enough. You know what I mean? Where it's like you said, you're branding businesses. And if anybody picked up on what you're saying there, you're going from self-employed into the business owner. that's a very difficult box transfer. You know what I mean? It's much easier going from the employee over to self-employed, but we have so many people that are self-employed today as contractors or whatever it might be. But going into the business box is like a whole different thing. You know what I mean?
Yeah. What's interesting though, Charles, is that I've been thinking about this lately. But at least the identifying as the business owner and being the business, owning a job. The interesting thing is that these days, depending on what your job is or how it translates, that isn't the worst thing in the world anymore. Because, for example, if you can scale on the internet, right? Like if you have, personal branding and personal influencer type stuff has infinite scalability, right? That's a fairly new concept. Like before, like you wouldn't want to brand yourself because, you can't grow enough. There's not enough of you. There's not enough time. But now there kind of is, if you're in that type of situation where you can create you and it lives on the internet forever. So just aside, but
yeah, you have that network effect. And usually from say 2 decades ago, before, let's say, Facebook or when Facebook was starting, that was a business. Obviously, it's grew so large because it had a network effect. And I think you have people that become very wealthy when they have the network effect. If you speak, there was someone in my neighborhood that had like 16 dental clinics. And it's something like, well, he got that network effect because he just had it and duplicated it. And it's one of those things where you can do that with social media. You can do that with a lot of these platforms, and you don't have to be like Zuckerberg behind it to witness part of it. So that's a very interesting point. I haven't had anybody bring that up on the show before. Yeah. One thing I found interesting, and when I grew up in central Connecticut, where I started buying property like 15 minutes away, there was a lot of Eastern European immigrants, and one thing, many Polish, and they would come in, and one of the first things they would do is buy property for everybody. You know what I mean? And they pay off these places really fast. And obviously, you're coming from late 80s, 90s from in communist country of Eastern Europe. There, what did you see? You must have been around a lot of other first gen people and immigrants themselves. Was that something that is kind of like synonymous? You'd come to the United States and you'd buy property because it's not as easy or available in other countries. Is that how it works?
Yeah, I don't know. I don't know if that was necessarily why. I think my dad just saw it as a purely entrepreneurial play. He just saw it as a cash flow play. I remember it's funny because when I was a kid, I'd say, Dad, what, people talk about investing. What do you look at investing in? He'd just say cash flow. And you know what? It's funny because like years later, reading the Kiyosaki book, he's talking about cash flow. And I'm like, my dad's been talking about cash flow since I was a little kid. Why didn't I listen to him? But I do think what's interesting about just to your point though, I do think that there is an interesting thing about people coming from other countries, especially on the entrepreneurial side. I always think about this too, because the type of person who leaves their country for another country has already got something that an entrepreneur needs, which is this potential appetite for risk and, doing something that's a big move. I mean, I never did it. Obviously it was my parents who did it, but that takes a certain kind of personality to make a move across seas and stuff. So it doesn't surprise me that those are the people who end up entrepreneurs and successful and buying real estate and looking for opportunities because they're already movers and shakers.
Interesting. So let's kind of transition to what you're doing now. You made your transition from being a high earning surgeon into a full-time investor. During that part, just getting people that are highly educated people to invest in syndications, I've always found as a more difficult endeavor than working with entrepreneurs to invest in them. How do you do it? And how do you change that mindset of just yourself changing from being that high paid professional into a full-time investor now?
So do you mean, how do I change my mindset or?
Yeah. How did you do your mindset when you made that decision? That's a huge thing. You're a plastic surgeon. You're making a lot of money doing that, more than most doctors or professionals in general.
Temporary insanity. And the thing is, what I did, I don't recommend to most people. I really don't. And in hindsight, I look back at what I did, and it's sort of not even believable to me that I would do that, because you're right. I was making a lot of money, like, as what you would expect a successful cosmetic surgeon to be making. I was doing really well. But I think it's that whole entrepreneurial bug. Some people are just kind of born with it, and the risk tolerance is extremely high. And, when I made that move, and this is probably about now so it was 2017 when ultimately I just left everything behind. Um, I had, hired, another surgeon and stuff to just take things over. But the reality is I knew that I wasn't going to make as much money because I don't get to keep a lot of the stuff that's operated on. So I thought that would keep me afloat while, I transitioned. And it did a little bit, but I think the thing is that once you make a decision to completely pivot into another career, the best way to accelerate that is to burn the bridges behind you. I didn't make it so you have like no choice. I did that. Luckily it worked for me. But honestly, it's funny because I look at that decision now and now I'm 52 and I'm like, I can't believe I did that. It's nuts. Absolutely nuts. And I highly dissuade anybody from doing that. But yeah, I mean, my story, I think is probably not, it's not typical, and it's not, something that everybody should do.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. So let's talk about kind of what you're doing now, what your investment strategy is with your firm, and kind of what is your current strategy with buying multifamily properties and your buy box, stuff like that.
Well, as you know, multifamily's taken a really big hit, and my model has ultimately been to partner with, operators and create opportunities for my investor group. And so right now, in terms of buy box, it's, looking at what's sitting wounded in the street, because there's, that's the opportunity. Routinely finding things that are 30 to 40% discounted compared to 21, 22. And, there continues to be this mismatch in expectations of sellers and buyers. And the only people who are really selling are people who have to sell. Right. And that's creating these situations that are unfortunate for, the sell side. But I mean, for those who are actually willing to actually go in and deploy capital in a market that's been ugly, I think it's going to be a great opportunity. It's one of those situations right now where I think Warren Buffett talks about how when, try to be greedy when others are fearful. Well, that's kind of where we are right now. I think a lot of people are fearful. I think multifamily in particular is taking an absolute, kick to the gut. And, other markets like the equity markets and stuff, stock market, they've not had that. They haven't had that moment. We had that moment. We got massively hurt. And if you can zoom out and you look at opportunities that when people make money in real estate, it's these moments when there's this kind of mismatch.
Yeah. Yeah. I find it when capital's a little harder to come by and when lending's a little difficult. When I started in 2006 and 2009, when we were buying property, I mean, there was no one lending. I went to refinance a property, and it's kind of like famously, I got one bank that I've been working with for years before that, and worked with my family. They gave me like a 20% loan to cost. You know what I mean? That was the only loan they would offer. I mean, you didn't have cash, you wouldn't be able to. I mean, you couldn't survive with what you were doing. You know what I mean?
And then it's hard to raise capital in those situations too, because, it's funny. I have a buddy who's really successful, and, he's a hotelier, and it's worth, he just sold something for $100 million. And, he was telling me that, he never raised money, right? But he tried around 2009, 2010, because he was looking at these hotels and they were trading at such steep discounts. And he would go to people and he's like, but we should take this down. You want to invest in this? No one wanted to touch anything. Right. Of course, like years later, he's owns these things, and people are asking him to invest when now those hotel markets were all frothy. So it's a psychology that you try to avoid, but you literally see it every day. Like, it's hard to raise capital when it should be times when people should be investing. So
it's not just retail investors. It's also, I find it always funny with lenders who are supposed to be more of a professional. And if like the floor went out, 20, 30%, and they're having issues about lending, and they're like, your capital's never been safer. You know what I mean? Like your capital couldn't be any safer right now than it was. But 12 months ago, you were hot, ready to lend. And now, because you have issues, you are now just this is where you should be deploying, but they never think like that.
No, it makes a lot of sense. Yeah, no.
So where we are now, I mean, the value add business has really, really changed, as you were saying. One of the things I found was that with properties that were built, I was talking at a meetup a few months back, and I was talking to someone, and they were saying that, we have some extensions on loans with properties. And I see that coming to an end now as properties are becoming, the value's coming back a little bit as they're catching up to kind of what the loan is on the property. But then the lenders are really forcing a lot of these property sales. And so the equity investors are wiped out. Lenders are getting their money back, and they were fine. We'll just push it back until they got their money. They weren't really too worried about lenders or about the passive investors. Now, how are you seeing it? Like, how, when you're taking over a property, obviously, if you're buying it right, I mean, there's not much of a value add you have to do other than really just wait and clean up some of the management. But how does a value add plan really work when we're talking market rents are stagnant or even slightly declining?
Yeah, I mean, I think part of that analysis is looking at what comps are. I mean, if like just as an example, I mean, we were buying something in Raleigh recently, and first of all, rents are. I mean, they're going up, but they're not going up at a big rate. But when you look at the comps on that, they were so far below where other properties were, right, in the submarket. So whereas there may not be a big wave of increases in rent, sometimes you pick out a given property where there clearly is an opportunity to raise rent just because you're looking at just trying to match the market. Right. So value add. You're right, though. I mean, there are other scenarios where, properties that we had in the past where it was a value add opportunity, but, it no longer makes sense to upgrade because of certain rent restrictions and that kind of thing. But I think as a buyer, you still have to look at what you can do to improve a property, right? Like you could whether that's operational, whether that's, upgrades or whatever, you have to look at what the comps are, and then you have to look at what the opportunity is. And I think that's the big key. I think value add is still possible. I know people saying, oh, value add is dead. Value add is still absolutely possible, but it's not a global thing that you can do right now. It's something, property to property that you can do.
Yeah, a very per case basis type situation. But if you're buying it with a large enough, like you said, rent discount, that's where your security is. That's how you minimize your downside, is by, hey, this is where the market is. This is where we are. That means we're not going to have really an issue with occupancy or vacancy while we kind of work through what's going on.
Yeah, you just have to stress test that. And, I still think once this Iran stuff cools down, I do think that we'll see these, cooling numbers in terms of inflation. And I do think rates will come down. But I think that's going to help the situation as well, because the rates went up so much, so fast that, it's hard to structurally put together the buyers and sellers because it's so far off. Now, I was thinking about this even just yesterday. We have some properties about, 2018, 19 that we still have that they're cash flowing like great, fantastic. And I'm like, there's absolutely zero reason for us to even think about selling these properties right now. Just none, right? Because it's like, why would we? Like the market is not a seller's market. So anything remotely that's making you money right now, that's doing well, you can't even think about selling it. So that's where we're at.
So within syndications, and it's one thing I don't know if passive investors see it as much, but it's definitely on the operations side of it. There's a lot of partnering that goes on. So you're partnering with operators, general partners are doing the deals, while your investor partners are partnering with you. There's a property management firm there. It's a whole thing is partnering. How do you suggest someone review a potential partner before you're actually working with them? And this could be to passive invest with someone, or maybe to take down like a joint venture actively.
There's a advantage that people have right now, in that the system was stress tested so significantly, right? And again, the Buffett quote about figuring out tide comes in who's swimming naked, right? And I think that's that's the opportunity right now. If you're seeing, in our case, I was working and I continue to work sort of in a multiple operator situation, and could see, which systems actually were better prepared and which were not. And so in my opinion, if you got through this, and here's a tricky thing, is I think some people think that just because an operator has had a bad outcome that they're not a good operator. But we have seen everybody who's really active, and some of the most quote unquote conservative, big name operators lose properties. And so I think you have to be careful to just say, well, if you had a bad outcome, I'm never going to work with you, because, that's tough. But I think what you can do is look at a big picture and say, this operator has, 30 assets or 40 assets. And they had problems with one of them. Two of them are, and they handled it really well. They did best they could. And they're still active now. Because if you're still active now and you're still buying, that probably is a good sign, because you've survived, right? One thing that's happened in this space over the last couple of years is, a lot of operators are gone. There's not very many left that are actively doing anything. So if you're actively still buying something, you probably did something right, because, you're still able to raise capital. You've managed your portfolio well. The other thing is there's not many people aggregating capital anymore, because it's very, very hard for the reasons we talked about. So
when I'm looking passively investing in a deal, there's some things that now, after being a active syndicator on deals, that I look for. And one thing is really the relationship that that operating team has with like their lender, and then most importantly also with their property management team and how many deals they've done with them. Is there anything else that you've realized over the years that maybe isn't front and center of what you hear people say when they say picking a passive investor or picking an operator to partner with or on a deal specific basis? What would you say is something that's kind of like a little bit hidden that you found that's a very important factor that people should look out for when passive investing?
I think, the track record is very important, right? Like track record is very important. I also think that, I generally, and it's not anything personal, but I don't usually look at sort of operating teams where there's like, just a couple of guys putting it together who've got full-time jobs. That's not for me very convincing. I look for, real estate firms. I look at companies that are buying real estate that's what they do. I think it's, does it make your risk go away? No, but it certainly mitigates it when you're sort of in a professional situation as opposed to just a couple of guys putting together a deal, right? Basic things, I think, like just lessons, leverage, how much leverage is there? Leverage is a double-edged sword to the 10th degree, right? I know I'm quoting these guys too much today, and I don't know why, because I don't normally do it. But Charlie Munger, he said there are three things that'll make a smart man go broke: liquor, ladies, and leverage, right? And that's the unique part about real estate, right? Is like the leverage is what creates the returns, but it's also what makes us extremely exposed to markets. So I think, not having too much leverage. And then the other thing is, I think it's important to have cash reserves, because I think the groups that that really did well had good cash reserves, and their leverage was not as significant as others. And those were probably two of the big things. I think the other thing that's challenging is with value add, it's very rare to have, it's very rare to fix that rate for, 10 years because you have a large prepayment penalty that you're dealing with. But if you can manufacture something where you've got a few years fixed by, more cap rate insurance, how much cap rate insurance you have, how many years of cap rate insurance do you have? All that kind of thing. Those are things to look at as well. So
yeah, there's as we're quoting people, Kiyosaki has this quote, and it's like, leverage is like a gun. You can protect yourself or you can shoot yourself in the foot. And I always think of that as because it's completely true. You know what I mean? You can get these huge returns, but you can also, which a lot of people do, is shoot themselves in the foot with it. And it can be a very dangerous thing.
Yeah. I mean, candidly, I would just say that, like, for me personally, it's like leverage has been my biggest wins and my biggest hits, my biggest losses. I mean, you just got to be really careful with it. It's like it's a nuclear, missile ready to go the wrong way and destroy yourself. So,
Buck, what are some of the lessons learned from building multiple successful businesses? Could be real estate or outside of real estate.
Yeah, and I think I think from the side of somebody who does that, I think it's really important to understand what your own skill set is, and not to try to become everything, right? You got to know what you're not good at. That's almost more important than what you're good at. For me, like I'm not a good manager. I don't like managing people, right? I like to be, and what I'm good at is the big picture, the vision. How is this going to work? But I don't want to be managing people. It's not what I enjoy. I'm not good at it. So I have to hire somebody like that. Right. The other thing is, like, from a syndication standpoint, like, It's interesting because I remember when I started the syndication idea, I realized that syndication was really two parts. One is like sort of the outward facing world of explaining the opportunity. And what my whole thing is educational marketing, right? Like I don't try to force anybody to buy anything. I mean, I want to understand and explain why I think it's a good opportunity. Then I'll just tell you why I think it is. And if that resonates with you, then you're going to invest. You need that part of the business. And then you need the people who are going from unit to unit, pounding the pavement. You need that element. It is very rare, and I would say probably never, that you can do both. And so you have to find yourself like, where are you in that picture? Are you the big picture guy who sees the vision, who can explain the vision, who, that kind of thing? Or are you like pound the pavement, operational kind of guy? And you have to find both elements of the team to make a business work.
Yeah. The integrator and the vision person, the two parts that really make that kind of puzzle go together.
Right.
Interesting. A lot of great stuff, Buck. Thank you so much for being on the show today. How can our listeners learn more about you and your firm?
Yeah, I mean, I think probably the best way to do that is just listen to the podcast, Wealth Formula Podcast. It's designed for high-paid professionals, doctors, lawyers, business people who, it's really a show about personal finance, how to view the world. We don't necessarily talk about deals and stuff like that. We do talk a lot about macroeconomics, get into personal finance, things like even, asset protection, estate planning, how to view the world right now. You talk about AI, whatever, but it's a broad educational platform. It's a Wealth Formula Podcast, and you can pretty much get that anywhere where you get podcasts, including YouTube, obviously usual Spotify, et cetera. So.
Okay. And then also people can check out wealthformula.com. Your website's got a lot of information on there and obviously links to all your social and all in your podcast as well.
Yep, absolutely.
Buck, well, thank you so much. Thank you so much for being on the show today. Looking forward to connecting with you here in the near future.
You bet. Thanks for having me.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.